Okay, overview of accounting for non-cash asset. Okay, like I mentioned, right? When we talk about assets, right, on the balance sheet, it's kind of like our life stage, right? It's sad to think about this. So from the cradle to the tomb, right? There's a point, okay, you entered in the life stage, right? And then, you are on the life stage for a certain period of short time, okay? And unfortunately, eventually, we are all going to die. So no offensive to anyone, we all are going to die, right? So from cradle to tomb, and so I am right now in the middle, okay? Maybe you guys are younger than me, but okay, so life is fun. I wish I can live longer, especially universities paying us a very good pension plan, right? So I really wish I can live longer. So basically, you have transactions. It's gonna generate assets. So the assets will be first recorded on the balance sheet, and then in the subsequent years, you are going to measure. You're going to measure all these assets value, and you report all these things on the balance sheet. And eventually, you're going to derecognize the asset. That means this asset is gone, right? That asset is gone. The asset will be removed. So from now on, we are dealing with, from chapter 5 to chapter 10, we are dealing with assets. So we're going to talk about this asset life cycle, right? The initial recognition, subsequent measurement, and the derecognition. That is the life cycle for every asset. So you're gonna hear me talk about these 3 cycles repeatedly, right? Because whenever we are introducing a new asset, AR, inventory, long-term asset, we're gonna talk about what's the journal entry for the initial recognition, what's the journal entry for subsequent measurement, how are we gonna measure it, what are the alternatives. We're gonna talk about what happened when we sell the AR, when we sell the inventory, when we dispose the PPE, right? Those derecognition, right? Okay. Okay, initial recognition, that's the cradle. Okay, that's the cradle. So the first thing is about when you spend money, okay, do you debit asset or do you debit expenses? So you credit cash, right? When you spend money, you credit cash or AP. But you have options to debit. You can debit expenses. You can debit asset, right? So what's the difference between the asset and the expenses? So before distinguish that difference, let's first distinguish the difference between expenses and expenditure, right? In our daily life, we often use these 2 words interchangeably, right? So, we almost consider these 2 are equivalent, right? So unfortunately, I have to give you an English lesson in a Chinese accent today, right? So what's the difference between expenses and expenditure, okay? So expenses is the amount reported on the income statement, right? That is the expenses. And expenditure is about a cash outflow, okay? A cash outflow is called expenditure, okay? So expenses, we are talking about items on the income statement. Expenditure, we are referring to the cash flow, okay? So what is capitalization? Capitalization means you record an expenditure, okay, as an asset on the balance sheet, okay? If this transaction has a future economic benefits under the entity's control and the results from the past transactions, which is the definition of the asset, okay? If that's the way we call this capitalization, it's because of the recording an expenditure, a cash outflow, as an asset, okay, as an asset on the balance sheet. Okay, asset valuation, okay. So, is the asset overstated, right? Is your accounts receivable overstated? Are you able to collect all the AR that is reported now, right? So you want to make sure you have to write down any balance that is not uncollectible, right? the valuation adjustment representational faithfulness, right? You do not want to overstate your AR, right? Derecognition. When you remove an asset from the balance sheet, that's the tone, right? That's the tone. So you want to determine if that asset should be removed. Okay. So you are selling inventory, right? When you sell the inventory, you transfer the ownership of the inventory from you to the customer. So you don't have the ownership anymore. It's not under your control anymore. So it's not your asset. You have to remove the inventory from your balance sheet, right? And also you're depreciating equipment cost over time, right? So that's how you derecognize the long-term asset through depreciation, right, over time. So eventually the net book value of the long-term asset will be zero, right, eventually. So we call this derecognize, okay, derecognize. Okay, now let's focus on accounts receivable. Chapter 5 is about AR. Let's talk about what is the transaction's nature. A receivable is the cash flow temporarily foregone. Why we say that? So this is a regular sales transaction. You debit AR, credit sales, right? That's the regular credit sales, right? Well, if you do not generate AR, you're gonna have cash. So customer either pay you cash or pay you AR, right? The fact that you received AR, you accept AR, you forgone cash, right? So they are substitute. AR and cash are substitute, right? So when customer buy things, right, they either pay with cash or they pay by credit, right? So AR and cash, they are substitute. The fact that you debit AR, you are not debit cash, right? So that's what we are talking about. In nature, a receivable is a cash flow temporarily foregone, okay? So think about it. If it's all cash sales, right? If it's all cash sales, you debit cash, right? The fact you debit AR, you are actually credit cash. You are foregoing the cash, okay? So now let's talk about discount. So when companies make sales, often they give a discount within term. Let's say, if you paid within 10 days, right? You get a discount of 2%, something like that. That's a common practice, right? The companies wants to collecting their money as cash as soon as possible, right? So they would have incentives to motivate the customers to pay the money, pay the cash earlier. So you pay earlier, you get a discount, right? How are we going to deal with this kind of scenario? There are two approaches. The first one is called a gross method. The second one is called a net method, okay? Okay, so here I'm going to show you, I'm going to compare the two methods side by side. I'm going to let you to see what's the differences between the journal entries, okay? Suppose you made a sale on May 1st, 2020, okay? For the gross method, you record the full amount of sales, okay? So you credit sales for 1,000 and you debit AR for 1,000, okay? For net method, remember net means smaller, right? Net method, you take into that discount right away. So there's 2% discount. So you only recognize sales of 980 and AR for 980. There are $20 discount on the $1,000. Does that make sense? So gross is high, the number is higher. Net method, the number is lower. Okay, net. Now, if the payment is made in 10 days, okay, you get a discount. So under the gross method, you collecting the cash, you collecting the AR, right? You're gonna close this account. So close credit AR for 1,000, right? So only when you do this, this AR is closed. The balance is zero. But how much cash you received? You only received the 980, right? Because there are $20 discount. So you debit cash for 980, right? And then you debit sales discount for 20. Does this make sense?
Yes.
Yeah, good,
Yes.
very good. Now let's talk about the net method. Can anyone tell me what is the journal entry for net method? If you received it within the grace period.
It'd just be it'd just be debit cash and credit accounts receivable for 980.
Okay, very good. Right, no problem, no question, right? You receive 980 and your AR is 980, right? Debit cash for 980, credit AR for 980. Okay, Philip, do you have a question?
Nope.
Okay, good. So now the question is, what if that customer really was tight with cash? He was not able to take advantage of this grace period, okay? So he paid after the 10 days. If you paid after 10 days, there's no discount, right? So how much he has to pay? He paid cash for 1,000 and credit AR for 1,000. Easy, right? So you debit cash for 1,000, you credit AR for 1,000, right? And the gross method. Because the payment is made out of the grace period, there's no sales discount, right? Okay. Can anyone tell me what is the journal entry for net method? How much cash
you
do you
debit,
receive? Yeah.
Cash debit.
you'll receive 1,000 in cash
Yeah.
and credit accounts receivable for 980.
Yeah. Okay.
And
Good.
then credit for, I don't know, what is the balance 20? Will it be sales discount, or in the book it says interest or other revenue?
Yeah. Interest and other revenue.
Why will it be under interest revenue?
Okay. So this is what happened, right? Okay. So the AR is 980, right? So you want to close AR by credit AR for 980, right? No problem. You receive a cash 1,000, right? You debit cash 1,000, so you need additional credit 20, right? In this case, because it's net method, right? Net method means in the beginning they already considered the sales, the net sales, right? Okay. The fact you did not pay on time, right? Remember time value of money, right? So you are using my money, right? You are using my money. If you pay me within 10 days, you owe me $980. But if you use this money longer, right? You're gonna give me 1,000. Why? Because the time value of my money, right? Right? That's why you recognize the interest income of 20. There's no sales discount because in the beginning, under the net method, you already can take into the consideration of the discount, okay? So by default, they assume everyone is gonna take advantage of the grace period. Therefore, they only recognize the net sales, right? For those who did not take advantage of the grace period, okay, that means you owe me money. You should give me the money in 10 days because I recognize only, I already give you a discount. So since you did not pay me on time, guess what? I have to charge you interest, $20. It's a different mentality, right? Does that make sense?
Yes.
Good, good. So
I
that's
have
the
a
difference.
question.
Yes, go ahead.
All right, so this is cash discount. So is this applicable to quantity discount as well?
Quantity discount.
Yes. So let's say that like the customer will get like 2% discount if they buy more than, let's say, 50 items, and the client buys let's say the client buys 40 initially, and after like maybe 10 days, the client buys like maybe 20.
Okay.
So making 6. So how do you do that?
Very good question. I think you made a very good point. So in this case, the discount is contingent upon the time, right? Upon the grace period. But you are talking about the volume discount, right? you are talking about if they purchase over a certain amount of volume, they get a discount,
Yes.
right?
Yes.
Yeah, that is a very good question. So so basically, if that's the case, okay, if that's the case, so you're gonna go, suppose it's a gross method, right? So then it doesn't matter the time, right? So suppose you have a discount, so what you're gonna do is you're gonna go with debit AR, okay, for 980, and you debit sales discount for 20. You credit sales for 1,000. If it's a gross method, right? Because in the beginning, you know they are already taking advantage of the sales discount, because when they made the sales, you know the amount of volume they are buying, right? So right away you can tell whether they are eligible for the discount or not, right? So when you first made the purchase, the seller know right away if you are eligible for the discount or not, right? Depending on the amount of volume you are buying, right? So then they would recognize the sales discount right away. So debit sales discount. They don't have to wait for 10 days to see if you are eligible for sales discount, because in the examples you are using, it's based on volume, and the volume is something has been predetermined, right? You don't have to wait. You know right away if the customer is eligible for discount or not, right? If they are eligible for discount, then just debit sales discount for 20 and debit AR for 980, credit sales revenue for 1,000. Does that make sense?
Yes.
Yeah? Okay, good.
Thanks.
Yeah, no problem.
Hi, I have a question here too.
Go ahead, Tim.
Sorry. Yeah. So what is like the correct sales revenue, or is it correct in each of their own way? Because under gross method, the sales revenue is 1,000, and then the net method is 980.
It's the same, right? It's the same. Let's take a look, right? Suppose the payment is made by within 10 days, okay? So the revenue here is 1,000, but there's a discount of 20. So the net is still 980. And here, under the net method is 980, right?
Right.
So it's the
Okay,
same.
yeah. I guess
the sales revenue is the same, yeah.
Okay.
So if let's say they did not take advantage of the grace period, they go here. So under gross method, sales revenue is 1,000, right? And under the net method, your sales revenue is 980, but you also have an interest revenue of 20. So your total revenue is still 1,000.
Right.
Yeah. So it's just two different methods. Your revenue will not be affected. It's just the way how you record the adjusting entries. Sorry, it's just the way how you record the entries, transactions.
Okay.
Yeah.
So will a company usually stick to one method? Like they won't switch back and forth between the two, right?
For that, I'm not sure. It's really depending on their business, their industry, their business, right? If they assume that most likely their client is going to take advantage of the grace period, right? Maybe net method will be easier to use, right?
Right.
So you just use these two entries, right? These two entries, right? It's easier to use, right? If you think, only a small percentage of customer is going to be able to take advantage of this, then you're gonna go with gross method, because then you use this entry and this entry. It's easier, right? Yeah.
Okay. All right. Thank you.
Okay. Yeah. Anyone else?
Do you have to declare on statements that you're using a gross method or the net method?
Yeah, I think so. Because it's gonna affect your sales, right? Under net method, you will not see an account called sales discount, right? Because there's no account under net method. There's no such account called sales discount, right? Under gross method, there's no interest revenue, right? There's no interest revenue. But under the net method, you could have an interest revenue here. So you want to, I think it's important that you disclose the method you are using.
Okay.
So it looks like, the growth method is very common, right? Maybe most of the client is not able to take advantage of the grace period, only small percentage. And conceptually, it's easier to think about this way, the net method this way. You assume everyone is going to take advantage of that, the discount, right? Just use the net method. For those of people, they not take advantage of that, they use your money for too long, so they have to pay your interest. Okay. Are you guys comfortable? Can I move on?
Yeah.